Hey everyone, and welcome back to the deep dive. Today we are going to be
Mhm.
looking at the Indian stock market.
All right.
So buckle up; it's going to be a wild ride. We've got
I'm excited.
yeah,
Looking forward to this.
I've got some great data to work with. We've got the weekly newsletter from Volatility Coaches of India,
Okay.
dated February 16th, 2025. And we've got some snippets about market capitalization to GDP ratio.
Great.
So this newsletter's got a lot of information for us, and we're going to unpack it. We've got PE ratios, PB ratios,
Mhm.
India VIX,
Okay.
and even expert predictions on potential returns.
Yeah, it's going to be interesting to see kind of what those indicators tell us about the direction of the market.
Yeah, let's jump right in. So this newsletter gives us a snapshot of some key financial data from the week of February 9th to February 16th. First up, PE ratio.
Okay.
Can you give us a little bit of background on what that is and maybe explain what this shift from 21.41 to 20.42 might mean for investors?
Sure. The price to earnings ratio, or PE ratios, it's often called,
Yeah.
basically tells us how much investors are willing to pay for each rupee of a company's earnings.
Mm-hmm.
And typically a higher PE ratio suggests high expectations for future growth. So in this case, we're seeing a slight decrease, which could indicate that investors are becoming a little bit more cautious.
Okay, interesting. And we're seeing a similar trend with the PB ratio, the price to book ratio,
Yeah.
which compares a company's market value to its book value. And that dipped from 3.51 to 3.41. So it seems like there might be some cooling off happening in these metrics.
Right.
What do you make of that?
Yeah, it's kind of tough to draw firm conclusions from just two data points, right?
Hmm.
It could just be a temporary blip, or it could be something more significant, a shift in market sentiment. We're going to need to watch these numbers over time to get a clearer picture.
Yeah. Okay, so a little bit of a wait-and-see approach with that.
Exactly.
Now, the Nifty 50 index, that jumped pretty significantly from 22,929.25 to 23,559.95. So that seems pretty positive,
Yeah,
right?
absolutely. Yeah, the Nifty 50 is like the benchmark index of the National Stock Exchange of India,
Mm-hmm.
and it represents 50 of the largest and most actively traded companies.
Right.
So, yeah, its rise really suggests a positive overall market sentiment.
Okay. Speaking of sentiment, let's talk about the India VIX,
Okay.
which dropped from 15.02 to 13.69. What can you tell us about that in relation to investor confidence?
Sure. So the India VIX, or the volatility index, that measures market expectations
Hmm.
of volatility over the next 30 days. So generally, a lower VIX is going to indicate that investors are expecting less volatility
Right.
in the short term.
So less ups and downs.
Less choppiness. Yeah, exactly. So this drop, really suggests a calmer market outlook.
Good news for people who don't like to
Yeah.
see too many ups and downs.
Yes.
Now, this is where it starts to get interesting. The newsletter talks about the Buffett indicator and projects a 6.2%
Okay.
annual return
Right.
for the Indian stock market. And there's a modified model that also predicts 6.2% return.
Interesting.
So can you unpack these models a little bit and tell us why they might both be pointing in the same direction?
Sure. So the Buffett indicator, it's also known as the market capitalization to GDP ratio,
Mm-hmm.
basically compares the total market value of a country's publicly traded stocks to its GDP.
Got it.
And it's a favorite of Warren Buffett. That's why it's called the Buffett indicator.
Right.
And it's often used to gauge whether a market is overvalued or undervalued.
So the macro view.
Macro view.
Yeah.
Exactly. And the modified model likely uses similar factors, but with different weightings, different assumptions,
Right.
things like that.
So the fact that they're both projecting a 6.2% return, that's pretty good, right?
Yeah. I mean, it's encouraging.
Mm-hmm.
But it's important to remember, these are long-term projections. They're based on historical data
Right.
and economic assumptions.
So we can't just take that to the bank and say, hey, we're going to get 6.2%.
Right. Don't put all your eggs in that basket just yet.
Now, let's shift gears a little bit and talk about foreign investors.
Okay.
The excerpt on market capitalization to GDP mentions that foreign institutional investors, or FIIs,
Mm-hmm.
aren't really seeing the same returns in dollar terms
Right.
because the Indian rupee is weakening. Can you break that down for us?
Right. So this is really crucial for those FIIs
Mm-hmm.
who are converting their rupee earnings back to dollars.
Mm-hmm.
Right. A weakening rupee means that their returns in their home currency are going to be lower.
Right. Okay, so how does this tie into the overall market performance then?
Well, it means that while the Indian market may be performing well in rupee terms, the actual returns for foreign investors
Mm-hmm.
might not be as impressive. And this can have a real impact on their investment decisions
Right.
and ultimately the flow of foreign capital into the Indian market. So investors really need to be aware of both the market performance in local currency and the potential impact of those currency exchange rates.
So a lot to consider on that macro level.
Absolutely, yeah.
All right, now let's zoom in on the Indian market itself
Okay.
and look at how different sectors are doing. What stands out to you in this sectorial index data from the newsletter?
Well, the banking and finance sector seems to be holding strong, which is a good sign, right? Often a good sign for the overall economy.
Right.
The newsletter also highlights IT and pharma as sectors of focus.
Well, yeah, no surprise there, right?
Right, those are, powerhouses
Yeah.
in the Indian market. But, always worth watching for shifts in performance, especially given, the global tech landscape
Yeah.
and the ever-evolving pharmaceutical industry.
Right. And speaking of things changing, it doesn't look like there are any sectors that are significantly underperforming. But I do see here that the Nifty Small Cap 100 and the Nifty Mid Cap 150 indices dipped a little bit.
Yeah.
What might that signal?
It could signal a little bit of risk aversion among investors.
Mm-hmm.
Who may be pulling back from those smaller, potentially more volatile stocks
Yeah.
in favor of, the larger, more established companies.
So a little bit of caution mixed in with this optimism.
Exactly.
All right. Well, before we move on and talk about the specific recommendations and the market trends analysis, let's stop there.
All right.
And take a quick break.
Sounds good.
Okay, so we're back, and we're still looking at this weekly newsletter from Volatility Coaches of India.
Mm-hmm.
And we were talking about some possible caution in the market.
Right.
Now, the newsletter goes on to give us some specific recommendations to consider, and they actually depend on what happens with the Nifty 50.
Right. It suggests a different approach based on different Nifty levels.
Okay, so let's break that down a little bit.
Okay.
What if the Nifty drops below 22,000?
Yeah.
What does the newsletter say to do then?
Well, then the newsletter suggests maybe a more aggressive approach,
Okay.
even recommending converting debt and gold holdings into equity.
Whoa, that's a pretty bold move.
It is, yeah.
Why would they suggest doing that?
Well, the thinking is that a significant drop in the Nifty, like that,
Mm-hmm.
really represents a buying opportunity.
Right.
You're accumulating equities at a low price. Essentially, it's classic buy the dip.
Buy low, sell high.
Exactly.
But that's probably not a strategy for everyone, though, right?
No, definitely not. It requires a high-risk tolerance
Mm-hmm.
and a long-term investment horizon.
So what about people who are a little bit more,
Right.
risk averse?
Yeah. If you're not ready to make such a drastic move,
Mhm.
the newsletter suggests focusing on large cap and momentum funds.
Okay. Can you remind us what those are and how they fit into that more cautious strategy?
Yeah. So large cap funds, those are the ones that invest in the well-established companies, right?
Mm-hmm.
Think of them as the blue chips of the market.
Right. So you're riding on the coattails of
More stable.
the strengths of those companies.
Exactly.
And what about momentum funds?
Momentum funds are aiming to capitalize on those stocks that are already showing a strong upward trend,
Okay.
essentially riding that wave of rising prices.
So different strategies for different risk appetites and different sort of predictions of what the market's going to do.
Yeah. And it's really about, aligning your investment strategy with your own personal circumstances.
Okay. Now, the newsletter also goes on to give us a timeline of market trends,
Right.
which I think is really interesting to see.
It's always fascinating to look back and see how the market is unfolded,
Yeah.
riding those waves
Yeah.
of positive and negative trends.
So, for instance, looks like back in August 2023, there was a bit of a rough patch.
Yeah.
But then since then, we've seen a pretty solid uptrend. What would you attribute that to?
Well, it's likely a combination of things, right? Positive investor sentiment always plays a role,
Mm-hmm.
but we're also seeing a favorable economic outlook, which is really crucial
Right.
for that sustained growth.
So things are looking up, but as they always say, past performance isn't a guarantee of
Right.
future results, right?
Exactly. Market conditions can change quickly, and that's why it's so important to stay informed,
Right.
not just about the Indian market, but about those global economic indicators as well.
Yeah, speaking of those global factors, I mean, we've really been focused on what's happening in India, but that global economic landscape can really influence what happens in India's markets as well, right?
Right. That's a great point. Yeah, and it's something to think about as you continue your research.
Mm-hmm.
The global economy is so interconnected,
Yeah.
and events in one part of the world can really have an impact.
Can you give some examples of what kind of global forces
Oh,
might come into play there?
yeah, I mean, things like changes in global interest rates
Mm-hmm.
can have a big impact. Commodity prices are another one to watch,
Right.
as are any major geopolitical events, right? Those can all create ripple effects that reach the Indian stock market.
So a lot of different things that we have to pay attention to there. Now, before we wrap up, I want to circle back to the performance of those small and mid-cap companies.
Okay.
We talked about, the dip in the nifty small cap 100 and the nifty mid-cap 150 indices.
Right.
But the newsletter also highlights their potential for growth.
It does. Yeah. And despite that recent dip, those indices have actually shown resilience, and they could be a really attractive option for investors that are, looking for those potentially higher returns.
So it sounds like investing in those small and mid-cap companies can be a little riskier?
It can be, yeah. High risk, high reward, as they say.
Yeah, finding that sweet spot, right?
Exactly. And that's where, a clear investment strategy really comes in.
For sure. Well, this deep dive has given us a lot to think about.
It has.
We've gone from decoding those financial indicators to understanding market trends to exploring all these different investment strategies.
Yeah.
What would you say are some key takeaways you'd like our listeners to walk away with today?
Well, I think, the overall sentiment surrounding the Indian market, it seems cautiously optimistic.
Okay.
We're seeing some positive trends in the Nifty 50.
Right.
That decreasing volatility indicated by the India VIX.
Yeah.
And those projected returns based on the Buffett indicator, those are all encouraging signs.
Definitely encouraging. But of course, projections are based on models, and those market conditions, as we've said,
They can change
quickly, right?
Quickly, exactly. So staying informed is crucial.
Absolutely.
Pay attention to those economic indicators, both within India and globally.
Yeah,
right?
yeah.
Don't forget about those currency fluctuations.
For sure.
Especially for our foreign investors out there.
Yeah. Another key takeaway I think we can all agree on is that diversification is important.
Oh, absolutely. Yeah.
I mean, we've seen some potential opportunities in a variety of different sectors, everything from banking and finance to IT and pharma, and even in that small and mid-cap space.
Yeah. I mean, spreading your investments across different sectors can really help to mitigate that risk.
For sure. And having a clear investment strategy is important.
Absolutely.
Whether you're a seasoned investor or just starting out.
Right. Know your risk tolerance, define your investment goals.
Yeah.
And be prepared to adapt as the market changes, right?
So much to learn, so much to explore. I mean, this deep dive has been a great starting point, but I really hope it empowers people to continue learning and exploring the Indian stock market.
Definitely. I mean, knowledge is power when it comes to making those informed financial decisions.
And I think we've definitely gained some knowledge today.
We have.
So thank you for all of that. But before we sign off, I want to leave our listeners with a final thought to ponder.
Okay.
We've covered a lot today, right? We analyzed those specific indicators and trends within the Indian market.
We did.
But we also talked about how that global economic landscape can really influence things.
Right.
So here's what I want people to consider as they continue their research. What global economic factors, beyond what we've talked about today, could have an impact on the future of the Indian stock market?
That's an excellent question. And it really highlights how interconnected that global economy truly is.
Yeah.
The Indian market doesn't exist in a vacuum.
Right.
It's influenced by events that are happening all over the world.
Absolutely. So much to consider. Well, I think that's a wrap for us today.
Yeah. Great deep dive.
I want to remind everyone to keep those financial goggles on.
Absolutely.
Stay curious and keep learning. Until next time, happy investing.